of the issues that's top of mind here at the SEC and for regulators is credit default swaps and derivatives. And you say that to the average person, and they have no idea what you're talking about. But it's not as complex as some might think, right?
No, it isn't. And I'd be happy to illustrate one particular derivative that's been in the news recently and show it's not as difficult to understand as one might first think, and also show, in a sense, the public policy complexities.
All right, so
that can
show
result.
us what we're talking about here.
Sure. So the basic notion is this. Say that you had a person who, for instance, is worried about having lent money to somebody, and he's worried that that corporation is going to go into bankruptcy, right? So one thing he might do is enter into a so-called credit default swap with a bank, typically, a derivatives dealer, where the customer would, in effect, pay what would be analogous to an insurance premium. If the company the customer is worried about goes belly up, goes bankrupt, the bank pays big bucks to the customer in return for that premium.
So the customer essentially has two bets. They have a bet on the company succeeding to make money, but if they don't, they have a bet to make money even if the company fails.
They have a bet on the company failing. So you could have a situation where the person just wants to use this device to simply bet on the company failing. And so he doesn't have skin in the game, but he wants to see the company fail. So it would be like short selling,
right?
An alternative to short selling. So this is so that you see this dazzling, you're intimidated by words like derivatives or credit default swap. If you look at the actual draw the arrows, boy, this is easy to understand as a product.
But one of the issues here, Henry, that you've written extensively about is the issue of empty creditors not having skin in the game.
Right. Well, that's the interesting aspect. Okay, we just talked about a credit default swap in terms of what it is, basically this insurance policy. And there are issues even with customers who haven't lent money, in a sense, betting on the company or country failing. Now, ignore that for a second and let me illustrate the empty creditor issue that you brought up. When you think about a typical bank lending money to a company, a creditor lending money to a company, dollars to the company basically promises, has certain rights, economic rights, as payment of principal and interest, various control rights. So, for instance, agreeing or not agreeing to modify the terms of the loan or other changes at the company, and various other legal rights. Okay, so say that you have a creditor who has lent $100 million to the company. Okay? So the company is delighted about the $100 million, is happy to give these control rights to the creditor because he knows that, well, if the company is running into a rough patch, the creditor, the bank, will work with the company to try to maybe extend the terms of the loan and so on. They keep it out of bankruptcy. The creditor normally doesn't want to see the company
because
go to
they
bankruptcy.
have their money in the company.
They have their money in the company. And so that's why the company is happy to give various control rights to the creditor. But let's think about the world with credit default swaps now.
The world as we know it now.
The world as we know it now. Let's pretend the extreme situation of an empty creditor, what in 2007 I called empty creditor. The creditor can buy a credit default swap too. That is, to buy protection against the customer failing, right? Against the company failing. So the creditor has much weaker incentives now to work with the company to avoid bankruptcy.
So why is this legal, Henry?
And
why is this not regulated? It's really off the books. It's over the counter.
This is one of the issues in terms of that I worried about as an academic, in terms of a lot of the rules governing behavior basically were set up before the derivatives revolution. And also, when you think about it in terms of these loan agreements, that the company never thought about this possibility. So people are becoming more aware of this possible issue.
More aware, but institutions are still doing just this.
Think about it in terms of economic concerns. That is that you may have a situation where creditors have weaker incentives to work with their customers to avoid bankruptcy. Whether or not they bought $200 million or even $50 million, they have weaker incentives to work with the company so as to avoid bankruptcy. What does that do in terms of world financial stability when there are lots of banks who don't care as much? This is an issue that is a live issue. It's an important issue. And notice the dichotomy between how simple this product, this particular derivative is, and the very complex issues it can raise.